Hello, YouTube. This weekend, we're going to talk about a pattern which tells us that the bull market may be at risk and we might be due for a little bit of consolidation. So sit tight. We got a good show for you this week. We're going to start here by looking at the pattern we just mentioned, where there are 5 steps we are going through. We currently have 3 out of 5, and the last 2 include consolidation and then potentially new highs if we are repeating the pattern. This is going to be important because for the month of August, we are now looking at a pattern where we're looking for 3 progressive higher highs to close the month of July out. And then we're looking for a little bit of a dip into August and close the month out flat. So rally up into the end of the month. So what do we have here on SPX so far? This is a line chart. We're trying to compare the seasonality chart here where we see 1, 2, 3, 1, 2, 3. We look at this next pattern here. What do we have? 1, 2, 3. It looks like it might repeat. Additionally, what could drive the market this week is underlined here for our economic calendar. The number one thing I will be watching for is going to be Friday, August 4th with non-farm payroll. And let me just close a few things out here. We also have GDP coming in as of Friday at 3.54%. That is an incredible number. It is the highest number going back to 2021. If we look here to the earnings for this week, we're now getting into the second most important week of the earnings season, and then it really drops off after that. The big one's going to be on Thursday with Amazon and Apple. That is right. That's like maybe $5 trillion in market cap right there. We got PayPal, Shopify, Qualcomm, AMD, and Starbucks. The B crew has been really what's driving the market right now. So I would kind of expect that we're going to hear more of that, more beats, more guides higher. And this is at a time when short sellers just won't give up. We note that they're still at about 232,000 contracts short, which historically is a pretty big number. And ironically, they might be right. We look here to our community poll. And what do we notice? We notice that we've asked you, this is with 600 votes. Thank you to everyone who does that. Right now, this is the first time that more people, as of right now, people think we're going to go up next week. So they didn't think it last week or the week before or the week before that. The last time they thought we would go up was the week of July 3rd. Ironically, when was that? That was the last red week. That's right here. It's the red candle. So is retail finally ready to go bullish, just as the market might be time to go down? Yeah. Then so that was the 1 week. Oh, sorry. Going back here to June 5th too. Do they have a 200% hit ratio? No, that was a flat week. So, anyways, that's a pretty big clue. I think we might be potentially a flat. So they might be trying to buy at the worst possible time as well, because we note here that even though we're still in extreme greed, we are losing a little bit of momentum versus last week when we were at 82, even though the price closed higher. What this means is that we're now flattening out. So the fear and greed is flattening out. And we note that we go down, we go up, we go sideways, we go down, we go sideways, we go up, we go sideways, we go down, we go sideways. What I'm trying to get at here is that it looks like we are going sideways. We have like a triple top in the low 80s. We still have a higher low, but if we fall back down to 75, that would be a warning for me, because it means that we're now going to be out of extreme greed and just into normal greed. And that is what we say. The saying is that you buy fear, you sell greed. Well, people are selling the greed, but they've been selling it for a long time because the market has just been not cooperative. So when we look here to the GDP, this number is now out. This is a big number, 3.54. So the thesis for the recession was that, hey, we're not going to really go up. This is the reason why we're going to go down. Fed's going to create a hard landing. And the reason why that's really interesting is because as of right now, we note that 3.54 is like better than any number going back here to, it's marginally better than 2022. So here we got 3.52, here we got 3.54. But the last big number is over here in Q4 of 2021. So like that's like this is like a really good number. And last quarter was pretty good at 2.4. So this is compounding. And we all know about compounding being that eighth wonder of the world. So what's interesting here is just that if we go sideways in a bull market, what is that? Well, it's probably bullish. So sideways in a bull market is probably going to be bull. And before we go further, I'm going to ask you for a huge favor. If you're still watching, I would really appreciate if you could consider smashing that thumbs up and subscribing to the channel. I would really appreciate it. And we're putting out videos every single day to try to keep you updated and informed with an edge to trade. So let's move forward and look at some charts now. If we look here to this pattern, what I just want to lay out is going to be a quick little story. And then at the end of the video, I'm going to walk through a specific trade plan and what I'm watching for the month of August. So for here, what I'm trying to just understand is whether or not history is repeating itself, because the saying is that history does not repeat itself, but it often rhymes. So we have a 3-step process here. Number one is crash land on the 50 moving average. Then we get a bounce. That's number two. When we violate or poke below the 50 moving average, then we reclaim it. Number three, which was a little bit more delayed here because of the banking crisis, we have a few extra candles, but then we do 5 back-to-back hollow candles. We break through the high of number one. So these 3 are checked so far. The part that's missing is 4 and 5. So if we now go here to go to S&P, what this would mean for me, and the reason why I say the bull market might be at risk is because if we look back here over time, what this shows us is the correction part, the one we're looking at here, number 4. It shows us a few things. It shows us that we have bearish engulfing candle on the first red one, and then we form an inside bar. So we get one lower low, and then we inside bar and go higher. But what I also want to note is just the relationship between the 2 big candles. So we have these 2 big candles, and we come down to more than the real body of the previous one, and we do come back below our number 1 high. So if we're tracking so far, what does that tell us? Well, let's just go to where we are now, and let's try to just look at that same thing now. And I'm just going to zoom in, but then I'll zoom out to try to show both. So when we look here, we got 2 big candles. So let's delete everything. Our number 1 high, first of all, is going to be right here. So, oops, what's going on here? Oopsies. All right, let's remove that. Let's go to the paintbrush, not the arrow. So at roughly 4,300 on the SPX, that would get poked below. And it said that we go at least down to the real body, but we did go, sorry, 1 monthly lower low, and then potentially down like 70% of the way to this real body. So it come down below here and then rally back up. So the question is whether or not the bull market is at risk because, well, is that still 20% off the lows? And there's a few different ways people calculate the bull market. Sometimes it's off of the absolute low or the low here at 39.41. And sometimes it's on a daily closing basis. So let's just see whether or not if we were to dip down to that area, we would still be 20% off the lows. So for us to be 20% off the lows, we have to maintain 4187. Let's just call it 4200. So 4200 is below the high here from number 1. It is above the low from here as well, which would mean that if we go below the June low at 4171, that would be where we exit the bull market. So if we fall below the box, that's where it's not just a consolidation before new highs. Well, we're probably going to go for a crash. Probably going to go back down to the 50 moving average. So I think that by looking at very high time frames, we can understand what a pullback. This would not be a correction. This would be a pullback. What I would say would cause a correction or a crash, or if the bull market's not just at risk, but the bear market is still the dominant one, we would need to see at least 2 monthly lower lows. So here we look and see, okay, we got 1, 2. We got 2 monthly lower lows, then we bounce back up. 1 monthly lower low. It doesn't really do anything. We bounce again. Inside bar. So we don't actually have the lower low here. We got 3,200, 3,230, 3,279. So we only print 1 monthly lower low here. And that's what I'd have to see. I would need to see that. Not a nice to have, a must have. And then the second part I'll watch for here is that every crash so far this year, we got the 4 right here, 1, 2, 3, 4. They all have a very repeatable pattern as well. What's the pattern? Well, first of all, we get upper wicks. That's number 1. So number 1 is upper wicks, right? Upper wick, upper wick, upper wick. We got those upper wicks here. Number 2 is that we print. So number 1 is we got upper wicks, right? We got the wicks. Number 2 is going to be that we have a full candle, a full red candle. That just means we're closing lower than we opened. So full red candle, full red candle, full red candle, full red candle. But now let's look and see what the number 3 part of the recipe is. So number 3 is we actually have a lower low. So when we look here to each one of these patterns, let's just delete everything now. Then we'll bring it all back and see if it makes sense. So the dip right here, we have a full candle. We got a lower low. There's our crash. And here we get the 2 red candles, lower low on the next candle. There's the crash. Once the lower lows stop printing, well, that's when we go higher. We notice those tails in the bottom. Let's go to the next one now. Next one here, we got, this is a higher low, and then the lower low gets confirmed in here. So dead cat bounce, rally back up, and then fade. So that lower low was the confirmation. Didn't happen here, and this will only be in hindsight. We're only going to know what happens for a lower low in hindsight. So that's what we note here. We have the lower low on the next candle. That's a pretty big move lower. We get a warning with a full candle, which means the expansion's not continuing, and then we get the confirmation we're going down after that. Same thing here. There's our lower low, and the red candle all in one. Not as big of a crash, but there's your pullback. Now we look at the last one here. So we got those upper wicks, we got the lower low, and then we go down, right? That's our crash right there. Then we rally all the way back up for yet another win. So the bulls win again, right? The bulls win. Boop boop boop. They win. They win. They just win. So that's like how we kind of form these inverts head and shoulders here, where we have like 1-2 dips on the left hand side, we have our head, and then 1-2 dips on the right hand side, and then rally back up. And we've not only taken out relative lows, we've also taken out relative highs. So if we're looking at this pattern, like the way that I would try to summarize this is that the risk of a pullback is now increasing because the velocity to the upside is not quite as strong. We don't yet have any evidence. We got hollow candles. We're above the previous weekly highs, but not by a lot. 45.78, 45.82, that's $4, right? That's 0.1%. That's not a lot. So 0.1% means, well, the margin for error here is pretty high. If we fall back below, we want to make sure we're aware of the potential for a crash before it happens. Why? Well, you buy insurance when you don't need it. And right now, insurance is cheap. It is 13 on the VIX with a 7% slam. So what does that mean? Maybe go out and buy some insurance. Why? Well, we showed you that. And for right now, the way I would qualify this is by just thinking about the seasonality chart now that we've gone through the pattern here. So the base case is that we're bullish. We would have to fall below 75 on the fear and greed to know that we're actually going into more than just a pullback. And right here, we note that we have the pullback, but then we're also anticipating that we actually rally back up and hold. So what would that mean? Well, the July low holds. Low for June, low for July. Sorry, low for July is right here. And then low for August is higher. It's higher than the July low. So what does that mean? We shouldn't break this chart. SPX should not break the chart. It should not come back down. It should not lose the 43.85 low. What I'm trying to lay out here is, well, what if we do? Would it be bullish? Would it be bearish? If we're looking for a pullback, which is how I'm defining this, the bull market would be at risk. We could reclaim the bull market, and then we go what? Well, we go up into the end of the year. So low, higher low, kind of double bottom, and then higher. Low, higher low, higher low. Each month we go higher. So this period right here looks like sideways. We already see that with the fear and greed. Maybe we get one more shot up, then we come back down, boop, right? And this right here in September, what could that be? Well, isn't the Fed supposed to have a meeting in September? Didn't the economic data come in most recently look pretty bullish? Yeah, so pump it into the Fed, fade it after the Fed, buy the hype, sell the news, and then we come back in after Labor Day and we pump it up more, rally up to close the year out, maybe a new all-time high. So the other thing I'll point out here is that we've been looking at a few different markets as a template to go to new highs, and whether or not you saw it, the DAX right now, as we're set to close this month out on Monday, we're here looking for like new all-time highs. It's actually a new all-time highs right now. So the DAX has got a bullish engulfing monthly candle set for new highs. Looks pretty strong to me. So we see the indigestion. I don't know why I can't draw on the chart right now. Let me just see here. Had the same issue before. Anyways, let's just go forward to a different chart here and see if this one works. There we go. So let's go to 1 month here. As we go to new highs, there's a period of consolidation before we actually do that. So that's kind of what this period right here would be, right? We go to maybe go to new highs, come back down, not sure. That's the DAX. So if we look at a different market now to try to understand what happened, well, let's look at one that is a little bit easier. Let's look at XLK. Different weighting than what the S&P is, but right now, what do you know? Oh my goodness. If we close here, again, we have to hold into Monday. That would be an all-time high record close. Oh man, and it's over the previous tops. Whoa. Yeah, 177.04, 176 are the highs going back to December of 2021. So that would be like pretty bullish. Wow. Yeah. Wow. And the reason why that's impressive is because this is just the first chart. If we go here to QQQ, because of the waiting for Amazon and Tesla, it's not quite at all-time highs yet. But we can note that pattern. So before we get too optimistic about where we're going to go on either QQQ or SPX or SPY, I think we might have a period of indigestion as we're looking to get up to these all-time highs here. We're pretty close. That Fibonacci number we've been looking at means we're at the 78% retracement. And that just means we've done about 80% of the work plus so far because we're here at the 70% retracement. So this would be like, oh man, my chart's trying to get a little bit messed up now. What we note is that like we've gone more than 80% of the way there. So again, a little bit of indigestion after having a huge meal is kind of normal. And then what can we do? Well, we could maybe resume higher. So that's really what it comes down to. And I think that because VIX is low, The dollar's dumping as well. We look here to the dollar. The dollar is rallying up a little bit here, but it's flirting with 100. If we get a leg lower, I would kind of assume that if we go below 98, it's going to cause even more downside pressure. Could look like that psychology chart. And as we look here to one more chart, or RSP, what do we also know? Well, we are above that same level that S&P is already broken over. That's that roughly 4,300 area. And we're actually battling for a 52-week high with pretty nice bull volume. So that shows me that like things look pretty good here. Okay, I'll just go back and clean these charts up after. It's not a big deal. And then as we look here to one last one, we're going to look at gold futures, but we just had rollover, so this candle's a little bit stronger than it would be otherwise. But as we look here to like to a monthly chart, the reason why I'm paying attention to this one, let me see if I actually have it here. I think this is the one I'm looking at. Yeah, here we go. So we have to go to a log. Right, here we go. We go log. And this one's important because it shows a massively bullish pattern. Normally, I don't talk about gold. This is a monthly chart. And the reason why this one matters is because the pattern. We have a cup with a handle, a bounce off the 50 monthly, and then we go where? To new highs. So as we go to those new highs, that's what I'm watching for right now. And I'm watching particularly close to 2,000. We're here at 1998. And as we look here to the current move, we're bouncing off the 50 monthly again with that cup and handle. So we have the bounce right here off the 50 monthly. We have the bounce right here off the 50 monthly. And we're over the previous high of roughly 1937. So that's what it looks like here. We have to see the confirmation, and a lot of people are not talking about this. So I'm watching for gold to make a new high versus the dollar, because gold has already made a new high relative to most other currencies. Well, what this would signal is that the Fed's tightening policy is kind of over. Gold provides no return like Bitcoin, and if gold is less popular than Bitcoin now, but it's flirting with new highs, and it finally gets there, that's going to be one of my big clues. So with that said, thank you for tuning in. I appreciate your support. If you want to see another update from last weekend in terms of how we got to here, you can now see that video queued up on the left-hand side. If not, thank you so much for watching. And I look forward to seeing you on the next one.